Hi, I'm Jimmy. In this video, we're looking at 5 different dividend stocks that are paying consistent dividends and appear to be reasonably priced relative to their own fair value. Now, we're using a few different fair value methods since these companies come from different industries. So we're using the fair value method most appropriate for each industry. Now, all the valuation methods and the charts and everything you see within this video can be found on the Investors Grow platform. So if you're interested in signing up, I'll leave a link to how to sign up in the description below. Okay, so let's jump right in. So our first dividend stock is US Bank. This is a regional bank, and oftentimes the best valuation method to use for a bank is price to book value. And when we look at their historical price to book value, well, we can see that they're trading slightly below their average, so slightly below their own historical average. Then when we jump in and look at their dividend history, well, we can see that they're paying slightly over 4%, almost 4.5%. I think that this consistently increasing dividend history is likely a good sign for investors. Now, banks have had a tough economic environment to deal with over the past few years since the yield curve has been inverted. But with short-term interest rates dropping recently, well, the yield curve is becoming slightly more normal, which is a good sign. Now, on the bearish side, there continues to be a little bit of pressure on the commercial real estate market, and that puts some pressure on their loan portfolio. But overall, this could be an interesting bank if we're looking to get involved with a regional bank. Okay, now here's another interesting dividend stock, but this one's a bit more of a defensive play, and that is Evergy, ticker symbol EVRG. So Evergy is a regulated electric utility, and it operates primarily in Kansas and Missouri. Now, to value a utility, typically the best valuation method to use is a price to earnings multiple. And we can see with this chart of the historical price to earnings multiple. Well, on here we have the orange line. The orange line is the industry average. And we can see that right now, Evergy's PE ratio is below the industry average, also below their own historical averages, which tells us that this stock is trading at a relatively good price compared to both the industry and their own historical average. Then when we jump in and look at their dividend history, well, we can see that they've consistently paid out and increased their dividends most years over the past decade. Now, one of the reasons that this dividend stock came across my desk is apparently they've seen a decent amount of business come from the surge in data center locations in the areas that they serve. So this could be a more defensive way to get involved with AI and the whole data center push. So if we're looking to invest in that type of thing, but maybe not directly in a company like NVIDIA or something like that, well, this could be a unique way of doing it and target some dividends. So clearly this is offering some data center opportunities, which I think is a good sign, but we just want to keep in the back of our mind that there's also been some bills that have been pushed out through the government in Kansas and Missouri that could offer some potential headwinds for this business. But right now it's trading at a discount, so this could be an interesting time to consider a stock like this. Okay, now we're jumping into a real estate company called American Tower, ticker symbol AMT. This dividend stock owns and operates 250,000 cell phone and broadcast towers around the world. Plus, back in 2021, they made an acquisition of a company called CoreSite that added 28 data centers in 11 major markets in the United States. So again, there could be some decent upside here. And this real estate investment trust owns properties around this type of business, which again, I think is a unique way to play the push towards more technology. Now, a good way to value real estate investment trusts are to use something called price to funds from operations. And this is a chart of their price to funds from operations. And we can see that the fair value would be about 220 to 230. Price to funds from operations is very similar to price to earnings. And then when we jump in and look at their dividend history, once again, they've consistently increased their dividend for a long time. Now, there's been a little pause recently as they sold off part of their India business, some of their international business, for about $2.5 billion. But analysts are expecting for their dividend to resume growth over the next year or so. Okay, now we're moving on to a pharmaceutical company in AbbVie, ticker symbol ABBV. Now, this company is a bit more direct, and typically discounted free cash flow is the best valuation method to use with this large type of company. And we can see that using analyst estimates going out the next few years, well, we get a fair value of about $214 per share. Then when we jump in and look at their dividends, again, they've consistently increased their dividend for a while, and there's no reason to expect for that to change. Add that onto the potential capital gains, and this looks like it's in a pretty good position. Now, they are facing some headwinds with their Humira drug, which is facing some competition that's pulling back. But they have two other drugs here. I don't even know how to pronounce those two, but those two are projected to do well and kind of offset some of the Humira pullback. So this could be an interesting dividend stock as well. Okay, now let's jump in and look at another defensive stock that could prove to be quite useful if the economy were to go into a recession. And this is the JM Smucker company. And we can see that when we're looking at analyst estimates and free cash flow, a discounted free cash flow, this stock has almost 40% upside, which is impressive. When we jump over and look at their dividend history, again, this is exactly what I've been looking for. I want companies that are consistently increasing their dividends, but also are able to grow their business. Now, they have made some acquisitions over the past few years. They bought the Hostess business, and their earnings per share has been a bit more volatile than I would have liked. Hostess business, I think, is a positive sign. Company being a bit more volatile from an earnings per share perspective, that's somewhat understandable. But over the long run, if this business could continue to grow, this could perhaps offer us a defensive type of business. Typically, if there is a recession, this type of company does fairly well. Now, please let me know which of these companies or a new company I should do a deep dive on, and we can get that video out as quickly as possible. In the meantime, thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.